This is chapter 9, video 2 lecture. So comparing depreciation methods. So if you take a look at this, here's straight line right here. It's even 4,400 all the way down. Units of measurement, it depends on how many hours you use, or it can actually be number of products. Like if you if you have a cost of goods and you manufacture something. So here are the number of hours, still equals 22,000. Double declining balance does happen quicker, and then the very last year it's very low. Okay, so keep those in mind. And here's what it looks like as you start to look at them on a bar graph. Okay, so again, you get with your double declining, you can expense most of your depreciation in the beginning, and then it decreases. Okay, so you can kind of choose. If you're a small business, you kind of have to go with straight line method, because with these other methods, it's kind of hard to keep track of, okay? Partial year depreciation, a fixed asset may be purchased and placed in service other than the first month of an accounting period. In such cases, depreciation is prorated based on the month the asset is placed in service. For example, assume an asset is placed in service on March 1 for an accounting period ending December 31. Depreciation will be computed prorated for 10 months, March 1 through December 31 of the following year. Assets may be also placed in service other than the first day of the month. In such cases, assets placed in service during the first half of a month are normally treated as having been purchased on the first day of that month. Likewise, assets purchases during the second half of a month are treated as having been purchased on the first day of the next month. So here's a little activity, straight line, units of activity, and double declining balance. So those are the requirements. It's asking us the cost is 34,000, 4 years or 1,000 hours. Residual value will be 20,000. That's what means that when we're all done depreciated, that's how much will be left over. It says 4 years or 1,000. Okay, so keep that in mind. The equipment was used for 280 hours during the first year, 262nd, 243rd, 224th. Okay, so we'll go through and calculate the depreciation on this asset. So here we go. Annual depreciation expense. So remember, 340 minus the residual value or salvage value divided by 4 years, so 80,000 per year. Okay, so straight line method, 1,000 divided by 4 years is 25%. So 25% each year. So 320 is our depreciable cost times 320. So the first year we can depreciate 80,000. 80,000, our book value then will be 260. The next year we take another 80,000 off. Now our accumulated depreciation, which is a contra asset, is 160,000. The book value is 180. Next year take another 80,000 off. Now we have 240 accumulated, and our book value is 100,000. And then the last year, finally 80,000. We're fully depreciated, and our value, book value, or residual value, or salvage value will be 20,000 at the end of the 4 years. Okay, so that's straight line. So units of activity, again, 340 minus 20,000, and it says 1,000 hours total use. So 320 per hour. So in our first year, we were told we used 280 hours. So 320 times 280 gives us 89,600. So that's our accumulated depreciation. Now our book value would be 250.40. Next year is 260 hours times 320. It gives us 83,200 or 172,800 accumulated, and our book value will be 167,200. Next year was 240 hours, 76,800, and all we do is multiply those two. Our accumulated depreciation will be 249,600, and our book value is decreasing at 90,400. And then lastly, in our year 4, 220 hours comes to $70,400 dollars of accumulated depreciation expense. So our total now accumulated, we're fully depreciated at 328,000. Notice how we're inverted. So that decreases, but that increases over there. So our book value is now 20,000. So that's the units of activity. And lastly, the double declining, so it's again 100% divided by 4 gives us 20%. So 20% times, or 25 times 4 times 2 gives us 50,000, or 50%. Sorry, numbers are a little bit off this morning. So 340. Now, take in mind we don't take into account the book value in this one. So 340 times 50% gives 170,000. Our book value is 170. So basically, in the first year, we depreciate half of it. Next year, we take 50% of our book value. 170 takes us to, we'll depreciate 85,000. So our accumulated depreciation is 255,000. Book value is now 85,000. Now we bring that 85,000 down here, and we times it by 50%, and we get 42,500. So our book accumulated depreciation is now 297,500. Book value is at 42,500. Okay, so from there we don't do that. We just take the 22,500 now, which is the difference between, all we have to do is get to the 2,000 left over. So we have to basically we go 42,500 minus 2,000 or 20,000, and we get 22,500. Okay, so then we're fully depreciated at $320,000. So under straight line method, depreciation is prorated based on the number of months the asset is in service. Here's an example: 220 minus 2 divided by 5 is 4,400. This is actually the first example we did, but first year depreciation. So we're saying we depreciated it for 3 months. So 3 divided by 12 is 3/12, and our depreciation for that will be $1,100. Units of activity method computes depreciation expense using an activity rate and the activity level for the period. Excuse me. So here's the example. So 10,000 hours, we divide 24,000 minus 2,000 divided by 10,000 hours, we get $2.20 per hour. So first year, $2.20 times 400 hours, our depreciation would be $880. And the last example, like straight line, if an asset is used for only a part of a year, the annual double declining balance depreciate is prorated based on the number of months the asset is in service. So double declining will be 40%, and then we go 24,000 times 40% will give us 9,600. Now we go 3 out of 12 again because we're using 3 months out of the 12, because we purchased it. We have to do October, November, December, so that's how we get the 3 months. Okay, so when we times that by 9,600, we get $2,400 for those 3 months of service. The second year depreciation would be computed by multiplying the book value on January 1 of the second year by double declining balance rate. So 21,600 times 40% equals 86,400. Estimates of residual value and useful lives of fixed assets may change due to abnormal wear and tear or obsolescence. When new estimates are made by management, they are used to determine the depreciation expense in future periods. The depreciation expense recorded in earlier years is not affected. So assume the following data. Initial cost is $140,000, 5-year useful life. Estimated residual value is $10,000. So to find the method for straight line is 140 minus 10 divided by 5. So our straight line method would be $26,000 per year. So $26,000 over 5 years. So initial cost 140. So $26,000 per year times 2 will give us 52. All right, and then our book value or undepreciated cost end of year would be 88,000. And this one is the revised depreciation expense. Let's see, book value minus residual value. So 88 minus 8. So we extended the years to 8. So we kind of adjusted it. So 88 minus 8,000 gives us 80,000 divided by 8 gives us 10,000. Okay, so we adjusted it. So estimate, and that's what it will look like. And then we kind of notice how it would have gone down really quick, but now we extended the life. Okay, so keep those things in mind whenever you're taking a look at depreciation expense. Repair and improvements. Once a fixed asset has been acquired and placed into service, costs may be incurred for ordinary maintenance and repairs. Costs that benefit only the current period are called revenue expenditures. In addition, costs may be incurred for improving an asset for an extraordinary repairs that extend the asset's useful life. Costs that improve the assets or extend its useful life are called capital expenditures. A lot of time you hear about, oh, they have capital improvements. Well, that's an expenditure. Costs related to the ordinary maintenance and repairs of a fixed asset are recorded as an expense of the current period. Such expenditures are revenue expenditures and are recorded as increases to repairs and maintenance expense. Okay, so if you're improving something, it's a revenue expense. Okay, so that's something to keep in mind as well. So here's how you would account for this. For you pay $300 to tune up a delivery truck, so repairs and maintenance expense $300, and keep in mind that goes to your income statement, because your revenues minus your expenses, and then you're taking that out of your cash account. After a fixed asset has been placed into service, costs may be incurred to extend the asset's useful life. Such costs are called capital expenditures, which we talked about a little bit ago, and are recorded as a decrease in an accumulated depreciation account. So here's what this looks like. Accumulated depreciation, forklift, $4,500, and we're taking it out of cash of $4,500. Let's see, because the forklift remaining useful life has changed, depreciation for the forklift will also change based on the new book value of the forklift. Okay, so such costs again are called capital expenditures and are recorded as increases to the fixed assets account. So a delivery truck for $5,500, and that's coming out of cash. So what happens is you're putting the asset back, you're putting $5,500 back into the delivery truck or the asset account, and that's coming out of our cash account to pay for it. Because the cost of the delivery truck has increased, depreciation for the truck will also change over its remaining useful life. So here's what we look at. Here's a graphic of what that will look like, a flow chart. Costs related to fixed asset benefits only current period, then it's a revenue expenditure, debit repairs, and maintenance expense. If it benefits current and future periods, then we have to split it. It's either an extraordinary repair, it extends the useful life, then it's a capital expenditure, then it's debit accumulated depreciation, and debit accumulated depreciation, that's what it is. Now, if the asset's improvement adds service value to the asset, then it goes to capital expenditure and we debit the fixed asset account. Okay, so that's kind of how these are the no matter which of these ones we use, our credit is always going to be cash, so keep that in mind. But these are the debits of it, of how you account for it, depending on what the benefit is. Discarding fixed asset. If a fixed asset is no longer used and has no residual value, it is just discarded. The discarded asset and its accumulated depreciation are removed from the accounts and ledger. Okay, so here's what this would look like. We're pulling out accumulated depreciation equipment off of our books. Okay, so we're pulling that accumulated depreciation off. We're also pulling off equipment, so we're completely pulling it off of our account, off of our balance sheet. Okay, so it says to write off equipment discarded. If an asset has not been fully depreciated, depreciation should be recorded before removing the asset from the accounting records. So here's what it will look like. Accumulated depreciation, it's depreciation expense equipment for $150. Accumulated depreciation equipment, $150, so that's being pulled off to record current depreciation on equipment discarded, and it's 600 times 3 out of 12, and 3 out of 12 means it's 3 months out of the 12 months in a year. Here's another example. Then accumulated depreciation equipment is pulled off out of 4,800. Loss of disposable equipment, 12,000, and then equipment, 6,000, and that's to write off equipment. So that's whenever there's a loss. So if there's a loss, this can be a debit. And keep in mind that loss actually goes to the income statement, because that's you can expense that out. To record, the entry to record the sale of a fixed asset is similar to the entry for discarding an asset. The only difference is that the receipt of cash is also recorded. If the selling price is more than the book value of the asset, a gain is recorded. If the selling price is less than the book value, a loss is recorded. So keep those in mind as well. So we'll take a look at that. So depreciation, equipment expense, $750. Accumulated depreciation is $750. Now, to record current depreciation, it's going to be $10,000 divided by, or times 9/12, so 9 months out of the 12 months was used, and then 10%. Okay, so that's how we got that $750. Now, cash was paid. So the book value $22,500 was used or paid for, and here's how we record it. So we pull the equipment off at $10,000, and we pull off our accumulated depreciation of $77,50. So the difference, we're having a debit of cash of $22,500. So someone's paying us cash of $22,50. Okay. Now, if there's a loss, then we only have $1,000 in cash. We'll be pulling the equipment off. Our accumulated depreciation is still $77.50. So then loss on sale of equipment, and this will be $12.5. Keep in mind, this still goes to our income statement, and this right here, this cash, whenever we have an increase, then that will also go to the it would go in as revenue. Okay. Either way, they still go to the balance sheet, or not the balance sheet, the income statement. So cash, we got $2,800, and then accumulated depreciation of $77.50. Equipment sale of well, this is assuming we sold it more for $550 more. So this is on the other side. The one previously recorded was a loss. This one is when we have a gain. So this gain, notice how it goes. It's on the credit side. So this will be the revenue that I had talked about earlier. So here's another example. Let's see, 9,500 is A, and then we sold it for 105,000. So let's take a look at this. This is the same piece of equipment we had earlier. That was 340,000. Book value is 20,000. So 32,000, 320,000 is what we're looking at. Depreciation is 25%. So accumulated depreciation was 240,000. So we'll go through and sell this equipment under 2 if we have a loss and if we have a gain. So here we go. So equipment sold for 9,500. So we sold it for 9,500. Our accumulated depreciation is 240,000. So we have a loss of 5,000. Okay. Again, that goes to the income statement. So 340 comes off the book, and that's 100,000 minus 95,000. Okay. And that's how we got that it was a loss. Now we sold it for 105,000, so now we have cash of 105 into our account. Our accumulated depreciation is pulled off. Accumulated depreciation of the equipment of 240. Our equipment was 340,000 to begin with, so we're pulling that off as well. So now we recognize a gain there, and that's 105 minus 100,000. So that's how we got the gain. Natural resources, some business own natural resources such as timber, minerals, or oil. The characteristics of natural resources are as follows. Naturally occurring, an asset that is created through natural growth or naturally through the passage of time. For example, timber is a natural resource that naturally grows over time. Removed for sale. The asset is consumed by removing it from its land source. For example, timber is removed for use when it is harvested, and minerals are removed when they are mined. Removed and sold over more than 1 year. The natural resources are removed and sold over a period of more than 1 year. Natural resources are classified as a type of fixed asset. The cost of a natural resource includes the cost of obtaining and preparing it for use. So here's what it looks like. So depletion rate is cost of resource divided by estimated total units of resource. So then step 2, to depletion expense is equal to depletion rate times quantity removed. Okay, so you have to have specific numbers to understand this component, and it's very, very intense and time intense, and there's a lot of estimates going on. So cost of mineral deposit was 400,000. Estimated total units of resource 1 million tons. Tons mined during a year 90 tons. So 400 divided by a million, so that gives us 40 cents per ton. Okay, that's the depletion rate. So then now we go 40 cents per ton. So in the first year we took out 90,000 tons. So our depletion expense is going to be 36,000. So depletion is a little bit different than depreciation. Very similar concept, but you're assuming that you're taking it out, and that's how much it's costing you. So depletion expense is going to be 36,000, and again that goes to your income statement. Accumulated depreciation accumulated depletion is 36,000, and that goes to your balance sheet under your asset, because again that's a contra asset. So here's another example: 126 million, and estimated that you'll take out 42 million tons. During the current year you use 3.8 million tons. So what is the depletion rate per ton? Determine the amount of depletion expense for the current year. Journalize the entry. So we'll look at those items. So depletion rate is going to be 126 divided by 42 million. 126 million divided by 42 million. So we get $3 per ton. So depletion rate times quantity removed. So $3 times 3.8 million tons gives us $11,400,000. Okay, so depletion expense is going to be $11,400,000, and our accumulated depreciation will be $11,400,000. Again, this goes to our income statement. This goes to our balance sheet as a contra asset. Intangible assets, long-term assets that are used in the operations of a business, but they do not exist physically, are called intangible assets. These may be acquired through innovating creative activities or from purchasing the rights from another company. Examples of intangible assets include patents, copyrights, trademarks, and goodwill. The accounting for intangible assets is similar to that for fixed assets. The major issues are determining the initial cost and determining the amortization, which is the amount of cost to transfer to expense. Amortization results from the passage of time or a decline in the usefulness of the intangible asset. Manufacturers may acquire exclusive rights to produce and sell goods with one or more unique features. Such rights are granted by patents, which the federal government issues to inventors. These rights continue in effect for 20 years. A business may purchase patent rights from others, or it may obtain patents developed by its own research and development. The initial costs of a purchased patent, including any legal fees, is debited to an asset account. The cost is written off or amortized over the years of the patent's expected useful life. The expected useful life of a patent may be less than its legal life. For example, a patent may become worthless due to changing technology or consumer tastes. Patent amortization is normally computed using the straight line method. The amortization is recorded by debiting an amortization expense account and crediting the patents account. A separate contra asset account is usually not used for intangible assets. So keep that in mind, there's no contra asset. So here's what this would look like. 14 years, $100,000. Amortization expense will be $200. Income statement goes to the income statement, and then patents for $20,000, and that's just $100,000 divided by 5. And keep in mind, there's no contra asset. There's no accumulated amortization. So that's what it's saying. For companies that develop their own patents through research and development or R&D, and any research and development costs are recorded as current operating expenses in the period in which they are incurred. The exclusive right to publish and sell a literary, artistic, or musical composition is granted by copyright. Copyrights are issued by the federal government and extend for 70 years beyond the author's death. The costs of a copyright include all costs of creating the work, plus any other cost of obtaining the copyright. The copyright that is purchased is recorded at the price paid for it. Copyrights are amortized over their estimated useful lives. A trademark is a name, term, or symbol used to identify a business and its products. Most businesses are identified by their trademark. That means that means it's registered in their advertisements and on their products. Under federal law, businesses can protect their trademarks by registering them for 10 years and renewing the registration for another 10-year period. So, legal costs of registering a trademark recorded as an asset. If a trademark is purchased from another business, its costs are recorded as an asset. In such case, the cost of the trademark is considered to have an indefinite useful life. Thus, trademarks are not amortized, but rather reviewed periodically for impaired value. When a trademark is impaired, the trademark should be written down and a loss recognized, okay? So goodwill, I believe we're almost done. So goodwill refers to an intangible asset of a business, okay? Reputation, things like that. Managerial skill. It's under GAAP, allow goodwill to be recorded only if it is objectively determined by a transaction. An example of such a transaction is the purchase of a business at a price in excess of the fair value of its net assets. So assets minus liabilities. The excess is recorded as goodwill and reported as an intangible asset. Okay. Unlike patents and copyrights, goodwill is not amortized. However, a loss should be recorded if the future prospect of the purchase firm becomes impaired. This loss would normally be disclosed on other expense section of the income statement. So here's how we record this. Loss from goodwill, impaired goodwill $250,000, and then goodwill $250,000. Okay, so that loss, we can definitely record that on the income statement. So here's a frequency of intangible asset disclosure for 500 firms. So number of firms, goodwill, 430. So I'll go ahead and let you look at that, okay? Comparison of intangible asset. Here's what it looks at. Your different intangible assets, the description, amortization period, and then periodic expense. Keep in mind all these expenses are usually go to the income statement. So I'll let you look at that as well. We won't do this. I'll go ahead and end this right here after this assets. I hope you guys enjoy these videos. Thank you. Have a good day.